Let's talk about escrow accounts when refinancing, meaning what happens to an existing escrow account after you're done refinancing. So if you do not have an escrow account right now and you're going to be refinancing, this video is not applicable to you. Okay. So if you have an escrow account now and you're going to refinance, this is absolutely something you need to listen to, watch, rewatch, read, whatever. We're going to put information down below. And obviously you can call us with questions, but this is important and it's kind of tough to get your head around, but you need to plan for what you're going to do for the escrows. So I'm going to speak as if this is, I am in Texas, but I'm going to speak for a loan, a made up fictional loan that is in Texas and is going to be refinancing. And I'm going to assume that they're currently paying taxes and insurance as part of their mortgage payment, meaning part of their escrows. Okay. So the numbers I'm making up. These are just, yours can be very different. So understand that. And obviously call us. We're happy to walk you through it, but this is very important. So listen to what's going to happen. So we're going to pretend that this loan is going to close in September. It's going to close and fund in September. Okay. So this mortgage that we're talking about, it's going to have an escrow account where for however long we're going to say the Smiths have owned this home, the Smiths have been paying 1/12 of the property taxes every month and 1/12 of their insurance, their homeowner's insurance every month. And it goes into a piggy bank, which the mortgage servicer is in charge of. They own it and they hold it, but it's technically the Smith's money, but that's what an escrow account is. You're putting it in there. And then annually, when the taxes come due at the end of the year, the mortgage servicer is going to write the check, or whoever's holding the mortgage or the escrow account writes the check to pay the taxes. And then whenever that insurance renews, they write the money for the insurance. Hopefully you know that because you have an escrow account. But I think that's good foundation just to make sure we're on the same page. So now it is September. We're about to close. Congratulations. You're closing on this refinance. When you're closed on your refinance, the escrow account, I'm going to use an example of just say there's $7,000 in there. That $7,000 is going to get refunded to you after closing, usually within about 30 days. Now, I'm not in charge, so maybe it's quicker, maybe it's longer, but let's just say it's 30 days in this example. So whether it's 45 or 60, I don't know, but call it about 30 days. You, the homeowner, or in this case, the Smiths, are going to get that $7,000 check because that's what was in the piggy bank at the time of closing. And it's never exact, right? It's $7,132.58, whatever it is. They get that check back after closing. Cool. That's not necessarily free money. Maybe it is, maybe it isn't. Here's why. That money was obviously slated to pay for the property taxes. And in Texas, those post in October and they are due, right, when they post. So taxes in Texas can be paid in October, November, December, and up till January 31st. Most people typically pay them at the end of the year, like December time period. But the mortgage companies, they determine when to pay when you have an escrow account. So the mortgage companies, but when you close on a refinance, if it's posted, you have to pay the bill right then. So that $7,000 may only have $2,000 left in it if the taxes have posted. But I'm in this example, that's why we're doing a September example. There's a bunch of money. There's $7,000 in this account. So the Smiths are going to get back that $7,000. Cool. Well, at closing, if they're setting up a brand new escrow account, they basically have to write a check for $7,000 plus more, because when they're closing in this Smiths example, they're going to skip a month's mortgage payment. So maybe their check needs to be $8,500 or whatever their monthly amount is, on top of the $7,000. So if they're paying 1/12 taxes, 1/12 insurance, whatever those numbers are, on top of the $7,000 is what they're going to have due at closing. Now, whether or not they write a check is up to them, sort of. Meaning $8,500 is due, right? Because $7,000 is going to come back to them into their bank account. That's good. That's great. But they're still got to have the money so that when the taxes are due, there's money to pay them. When the insurance is due, there's got to be money to pay it. So this $8,500 in my example, do they write a check or do they roll it into the loan? So if they decide to write a check for it, that's going to hurt. That stings. $8,500 is a lot of money, but that does, if they pay for that at closing, good for them, but they can know that when you zoom out 90 days later, it's a net zero, meaning the $8,500 check they wrote, 7 of it comes back in the escrow refund, and they skip a month's mortgage payment in this example, which is in this example, $1,500. So they basically save the money back, right, through the refund, as well as not writing the check the following month for the mortgage payment with an escrow account. So if they choose to write that $8,500 check, good for them. A lot of folks, and I do like this option a lot of times, a lot of folks will say, man, I don't want to write an $8,500 check. Throw it onto the loan balance. So if you add it to the loan balance, then it means that the $7,000 check they just got is free money at that point, right? Because now the new $8,500 escrow account, which has the loan rolled into the loan balance so that you don't have to pay for it at closing, the new escrow is set up, and now that $7,000 is kind of like found money. It's like doing a mini cash out refi. So I'll put a link to talk about that a little more, but it's the same principle, right? What I just described, but the cash out, mini cash out, I'll put a link in here for that article as well. But that's ultimately what you're doing with an escrow account. So if you have an escrow account now, you will get the money back unless you net escrow. So again, I'll put a link for that. That's different. But in most cases, folks structure it to where it's like you're going to get the money and the cash coming back to you. And then oftentimes people will roll the new one into the loan balance so they don't have to worry about writing a big old check at closing. So that is what happens when you have a mortgage with an escrow account and you do a refinance. You need to decide, do you want to write a check at closing, or do you want to roll as much, whether it's some or all, how much do you want to roll into your loan amount to account for that? So if you don't want to write any, it's okay. Like I said, 60, 90 days from now, no harm, no foul. You wrote the money, the check at closing, and then you got reimbursed through your refund and skipping a month's mortgage payment, but it still doesn't feel good. But if you have the means and ability to do that and you want to keep everything the same, great. But if you could use an extra $7,000 to pay off credit card debt or to do whatever you got to do around the house, that may be a good option too. So I understand this is a lot. Please rewatch this video as needed. Make sure you understand it. Make sure you know what to do so that when we ask you, and we can help you walk you through this, right? Because every situation is going to be different. But when we ask you, what do you want to do? At least have an idea and have been thinking about how to structure your loan. We'll certainly give you our 2 cents when we look at your financials. And whenever you tell us your wants, dreams, hopes, and wishes, we'll let you know what we think is best for you. But as always, guys, reach out to us with questions. And when you think mortgage, think Mark.